So it's a pleasure to meet you. Okay, so it's a pleasure meeting you all, and I'm seeing everyone's names on the attendees. So feel free to jump in and ask any questions. This can be a much more relaxed, I guess, webinar where we can make it interactive with you guys and talk about your businesses, talk about your questions, and talk how can we help you, orient you through guiding the expansion to the US or in general just expansion strategies. So I will start and I will share my screen. Let's see. Let me know if you all can see.
Yes, we can see.
Okay, perfect. Okay, so we are CFOStartUp, and we're actually now just rebranding to Lasso, which is going to be our brand for starting in May. And we are a startup that provides services in terms of products for all of the accounting, tax, legal, and also financial aspects that you guys will have and will encounter when you are creating a company or expanding towards a different region, a different country. And so we can help you with whatever you need. And we basically offer two things for founders, and we try to focus on peace of mind, which is providing a peace of mind to the founders that they can focus on their product, on their business. And we can help out with all of the other administrative and different tasks that arise from the general business itself, which includes the legal aspect, whether it's a incorporation to a different country, or setting up contracts with your employees, setting up contracts with your providers, or internally between the employees or with another service provider that you may be having business with. And also on the legal side, we help you with setting up all of the investment rounds, and in general we are VC-backed startups. We are focused on VC-backed startups, and that's our main goal to help give you companies raising a seed round and keeping your company along the way. So that's one aspect of what we offer, but we also can take care of everything in the accounting and the tax side, which is what's usually required for startups which are getting invested, and we can take care of the monthly bookkeeping to have all of your books and records in order and in time, so that you can show them to investors, and also use them internally for your own screen and your own purposes. And when that cycle ends, that the annual cycle ends, we also help out with all of the tax obligations, the tax preparation, and the tax filing of the tax forms. And so that's in general the first pillar of our business, which is peace of mind for founders of everything that goes on in accounting, tax, and legal. We can take care of that, so that again you can focus on your business. And on the second side, which is the second pillar of CFOStartUp or Lasso, is to help you in all of the strategic financing and strategic finances and legal aspect of your business. So we offer also the fractional CFO services and the fractional controller services to keep you company on all of the finance related and the legal related aspects of your business, whether that's raising a funding round for your business, or setting up the term sheet, setting up a cap table for your business, and getting in general our business, our objective is to get you investment ready, so that VCs and investors can see that you have everything online, everything set up and coordinated with your vision, your mission, your speech. They can see that you're a well-prepared startup to receive investment. So in this webinar today, we are going to cover specifically the expansion strategies to the United States. And we're going to see the legal and the tax system, so that you can have it as an overview for whenever you're thinking or preparing for an onboarding or an inbounding to the United States. So in general, when we see startups across the globe, we see that they do not want to focus only locally, and it's very common to to expand to other jurisdictions whenever we are thinking about creating a scalable business with product and that will feed the market not only locally but also around the world. So in general, we see startups that are preparing a software, developing a software, and are much more scalable and product focused, for product oriented, and it's much easier to expand and to grow is to expand, which is the first image that I set up, and to expand means usually to take a much higher market because of all of the globalization. It's easier to reach other jurisdictions and to make a greater impact and make more business because you can reach a higher audience, right? And specifically in the United States, we see that venture funding keeps breaking records across the board each year. As time goes by, we see how the numbers raise for the money invested in startups that are not specifically located in the US, but they have a expansion strategy already set up where they're locally in each of their countries, whether it's in Europe or in Latin America, but they want to raise money in the US. And usually the VCs in the US ask for a legal entity in that country that can be as holding, and that can be used as a holding company for the investors to invest in, because it's they usually ask that for that requirement, and it's a great business overall, and we'll talk through the benefits of incorporating in the US. So usually these are the two alternatives of the United States when we enter the market. And the first one is to set up a holding company, which is a company that's not really operational, that would only receive investment from the investors, and then send that funding directly to the actual operating companies in each of the local countries. And so the company would only be serving as a vehicle for receiving an investor, setting up contracts with them, and then the actual operations would be in each of the local countries. And then the other usual alternative that we see is that the company in the US actually serves as an operational company, which means that all of the billing and the payments of the contractors, the employees, is generally centralized through that operating company in the US. And then we have the different markets that the company is operating in, but not through a specific vehicle. And this will depend usually on the business and in general, the strategy that's set up. But in general, in the United States, you would have access, to the world economy. The United States, it's one of the largest market to be operating in. So setting up a company, a legal entity in the United States, is actually a door to a whole new world, a whole new business that could be really beneficial to get to more customers, get to more clients, and in general scale your business. And then also the United States is different from other jurisdictions. It has a lot of legal history, and it's well known for a lot of years, or more than 20, more than 50 years, for all the legal history that they have in terms of favoring the businesses, favoring the local economy. So that's a good thing to have, because in some cases there are other jurisdictions that come out of maybe they set up a new legislation, but they didn't really have a legal history, so you don't know what to expect in terms of predictability when it comes to other jurisdictions. But in the US, you would have that stability in terms of the history. It's also very easy and fast to inbound, to create a company, and you can do it remotely as well. So that gives you a benefit to create a company from wherever you are located, and it gives you the speed that you need to set up a company in that regard. And also it provides general flexibility in terms of billing and invoicing, in terms of legal requirements. Usually the legal requirements are much more rigid in other countries than in the US, because, and you will see in the next slides, but they basically want to focus on all of the tax aspects and the tax obligations, which is why there's a general flexibility in terms of the format of the invoicing. You don't need to register and submit electronically an invoice to the government, or it's a generally much more flexible country to be operating and to doing business in. So I will now move on to the entity structures in the United States, and this is just a brief and general overview of the types of entities that you can set up. Usually there's two big types of entities, the LLC and also the corporation. The LLCs, whether it's a single member or a multi-member, which is 2 or plus members in an LLC, are entities that are pass through, which means that all of the income, all of the expenses that they have, they are generating in that company, they pass through the owners. So they don't, and we will see that in the following slides, but they don't pay taxes for their own, and the legal obligation and the tax obligation comes to the owner. And this is the biggest difference between the LLC and the corporation. In the corporations, you have a legal independent structure that would be treated as its own, and you would pay taxes, and it would be liable for everything on its own. And then on the right side, you have a couple of different aspects to consider when also creating a company in the US. And it's basically when you set up a structure in the US, it's a door to operating in the US, which is what I mentioned before, and also provides liability protection. Instead of operating on your own, it's better to have a vehicle that would serve as providing the business and generating the income on that entity instead of on a personal level. Also, the residency status is something important to consider, because the US makes a good differentiation between whether you're a US or you are a foreign resident or a non-US resident, and that means that there's usually different types of obligations and different types of requirements for each of the residency status. So also the formation is remotely, which is what I mentioned before. It's very easy to set up a structure, and everything can be done remotely, and also the upkeep or the maintenance can also be done remotely, and not necessarily in the US. Whether you are creating a company, paying your taxes, filing your tax returns, or opening a bank account, all of those solutions can be done remotely, and there's a lot of options and alternatives that can be used. And again, this is setting up a structure is usually a vehicle required from VCs or investors. So keep that in mind. Okay, so now let's talk about the taxation system. And this phrase that I have set up in the screen is what we usually use when we speak to prospects or actual clients, and which is that the United States allow themselves to be flexible in the formal matters because of the rigorosity in the fiscal matters. And this is again what I said before about having everything in order in the US means having your company legally set up and with all the documents, but also, and most importantly, to have everything fiscally taken care of. And this is what we've seen through our past, through our history, that the most important thing in the US is to take care and to have everything in order in the fiscal matter. And we will see why, but it's basically because of the penalties that the US imposes on certain items on the taxes side. So on the United States taxation system, they actually moved from a worldwide to a territorial system back in 2017 when they enacted the US tax reform. But it's never, you know, a one way ticket to one single taxation system. It's usually hybrid, and this is usually the case in every country in the world. So they actually have a territorial / worldwide hybrid taxation system. And this means that they would generally tax everything that goes on in their United States territory. But also there are certain, you know, regulations and politics that would also tax on certain items of worldwide income. In general, in the United States, you would have three types of three ledgers or levels of taxation. The first one being the federal, the nationwide, which is what needs to be filed and paid to the IRS. Then you have the state taxes, and the state taxes vary from state to state. Each state has a legislation has the power to set up their own legislation based, of course, on the federal side. But they basically just give instructions and requirements depending on their own interpretation. And all of the 50 states, it's very important to know that when you operate in a state or in one state, you may be liable for taxes, even though if you have the same operation in both. We'll see what items are to be considered when we're speaking about states. But also the third level or the third ledger is also depending on the state. In some states, they also provide, you know, power to the counties or the cities to also impose a different tax. So this again depends on a state to state, but in general, you would have these three levels of taxation in the United States. So this is usually, you know, a very broad description of what direct tax and indirect taxes are. The direct taxes are the ones that are paid directly to the government, and they are not shifted to any person or group. And these are usually the taxes that are paid directly to the federal government. And then the indirect taxes are usually the ones that are imposed by each state. And these are the ones that are passed on or shifted to another person or group that actually pays that tax. And this is usually the sales tax. You know, when you make a sale and you see in the receipt, when you're purchasing something, you see sales tax. That's the indirect tax that gets imposed based on a state-by-state level. So the direct tax. Going back to our first initial, you know, slides on the entity types in the United States, this is what the entity obligations are in terms of direct tax, in terms of forms, in terms of the taxation at the entity and also at the shareholder level. So you can have it handy when you're thinking about, you know, expanding to the US. So basically, and to go through each of the lines, the single member LLC has the biggest difference on whether the owner, because it's a single member, the owner is a US resident or if it's a foreign resident. If it's a US resident, the LLC doesn't have to file a tax return for itself. Instead, everything has to be filed with the individual tax return in what's called a Form 1040. However, and this is what I think is the most important thing, when we are speaking about a foreign resident that's owner of an LLC, and it's a single member LLC, they also have to file an informational tax return for the LLC. So this is different from being a US resident. If you're a foreign resident, you have to file something specifically for the LLC informationally. And then if you, as a single member owner, you have US sourced income generating through that LLC, you would also need to prepare and file a Form 1040 for the individual tax return. So the taxation is what I was saying, and it's basically you need to determine whether you have US sourced income or not. And this is basically the key when we are speaking about expansion strategies in the US in terms of taxation. The source of the income will determine whether you are liable to pay taxes in the US or not. And then there's guidance and there's a lot of regulations around the sourcing of the income. And it depends on the activity, it depends on the residency, it depends and it depends on the clients that you have, it depends on the contractors that you have. So there's a lot of variables to consider. But that's one key aspect that you need to ask yourself when you are incorporating in the US. So the second line is the line for the corporations. And corporations, they file Form 1120, which is the general form for corporations where they need to prepare their balance sheet, the P&L, and just report general information about the corporation. And if it's a foreign resident, usually there's additional forms to be filed. And on the taxation side, the entity itself will be liable on their income on a 21% fixed tax rate. That's a federal corporate income tax rate. And then on the shareholder level, they are not taxed immediately, but they're taxed when they're receiving dividends from that corporation. And the tax rate, it varies from the range of income that they received from that dividend. And the third line for the multi-member LLCs, this is 2 or plus members of an LLC. The slight difference between the single member and the multi-member is the amount of information that needs to be presented to the IRS. And basically, the multi-member LLCs are treated as a partnership for US tax purposes as a default, but then you can switch, the entity type with the IRS if you want to elect to be treated as a corporation. And the partnership or the multi-member LLC, they file the Form 1065 and also a Schedule K-1 for each of the shareholders, attached to that Form 1065. And the taxation, again, as an LLC, is done on a shareholder level where they will report their share of US source income in their individual tax return, and they would attach a Schedule K-1 that they received from that partnership. Okay, and this is what I was referring to before as why are they, rigorous on the taxes side, and why they allowed to be flexible on most of the formalities, right? Because the IRS, and this is for direct taxes only, the IRS charges a penalty for various reasons, and this is including basically if you don't file on time, or if you don't pay any taxes that you owe on time, or if you don't prepare an accurate return, a substantially accurate return. So that's why we have to understand the requirements and fulfill them in the form and timely manner. And the penalties for the US residents are much more, are much less significant than for the foreign resident founders. So again, this is one key aspect to consider when you are incorporating, and to try and keep you from getting scared. This is usually something that needs to be taken care of, but it's not something to worry about. It's if you have everything online, you have everything prepared and accurately filed, then you will not have any issues. But again, something to consider, and something that some founders don't take into consideration when they are preparing, and setting up in the US is the amount of penalties that you may be charged if you don't pay or file your taxes in an accurately and timely manner. Okay, so for direct taxes, following up on these are two of the other direct taxes that are less common, less frequent from the federal taxes, but they also exist, in terms of states and the state legislation. So the franchise tax is a tax imposed in some states. This is where the state legislation comes in for companies that are doing business in a particular state. So it's basically just a license to operate. In Delaware, which is usually the state that many companies incorporate in, it ranges from a fee whether you're an LLC or a corporation, but it's a fixed amount and it's paid annually just to be registered in that state. And the property tax is a tax that's paid on the property that's owned by an individual or by a legal entity like an LLC or a corporation. And this also depends on a state by state. So, and this is the last part about indirect taxes. And in the indirect taxes, what we have to determine is, well, first of all, this is depending on a state by state legislation. So each of the states, and you will see in the right side picture, the coloring, it basically tells you how are they considering what they call the economic nexus. So to be liable for indirect taxes, you have to consider the two aspects of nexus. Nexus is determining whether you have a connection with that state or not. And that connection can be done, or that nexus can be because of two main reasons. The first one being the physical nexus, and this in general will be whether you have an employee in a state or a physical property in a state. So if you have an employee in California, then that's probably a reason for nexus in California, and you will need to register in California as a corporation and also, or an LLC, and also be in general liable for the income that you're generating in that state. And the second one, which is the most important when we're talking about expansion strategies and doing business in the US, is the economic nexus. And this is a rather new legislation that arose since the start of the software as solution companies that are creating product that are selling to US customers. And the economic nexus is triggered basically when there's an exceeding certain amount of gross sales in a particular state. So in the chart on the right side, you have that everything that you see colored, that's all of the states that have the economic nexus. And the ones that that have a lighter color, those are the ones that are not. But in general, most of the states have the economic nexus, and it's usually when you surpass a certain amount of sales that's over $100,000. So again, each of the states has the authority to impose its own sales and use tax, and subject to to US constitutional restrictions, of course, to be in line with what's on the federal and national legislation. But each state determines, and each state you have to consider how are they treating the sales, what is the activity treated as when you're doing business in the US, and do you need to pay taxes? Do you need to register in the state and start paying taxes or not? So the types of indirect taxes, and usually the first one is the one that's seen the most, which is the sales taxes. And the sales tax, when it was originally created, it was when you would sell an item or sell a physical good to someone, and in the old times, that was when when you went to a supermarket and you bought an item from that market. So that physical transfer of items would be generally subject to sales tax. But again, since a couple of years ago, the software as a service may also apply for sales tax, and this depends on a couple of different items. And this is I think the most important one when we are speaking about new businesses, scaling and product businesses, is determining whether your software qualifies as a provision of services or a transfer of goods, basically. And then determining in each of the state whether that activity qualifies to be liable for sales tax or not. But then the use tax, and this is something that's not as frequent, is defined as a tax on the storage, use, or consumption of an item or service on which no sales tax was paid. This is usually just the use of a property, or it's usually the use of a property that will get taxed. But again, this is just to keep that in mind, but it's not as frequent. Okay, so I think that we've reached the end, and we're good on time. So now it's the time for the Q&A. I think that we have four chats. So
yeah, thank you so much, Federico, for this. We have so far one question from Kaushal, and the question sounds like this: what is the reason for creating the holding company separately?
Okay, so thank you, Kaushal, for that question, and welcome. So the reason for creating the holding company separately in general is because the investors want to see a company that they invest in, and that company can centralize all of the operations that you have around the world and locally. It's usually a way to set up a structure where that company would be the owner of all of the other subsidiaries or of the other local companies, and as a centralized holding company, you can have the investors invest in that company instead of each of the particular local entities. Yeah.
Kaushal, I hope we answered your question, but if you want to ask any more questions, or if you want to ask something regarding specifically this question, you can, if you raise your hand, I can invite you on stage. Oh, okay. So I'm going to give you permit, yes.
Thank you for answering that question, Federico. That helps. I have another question, and my colleague Chetan will just raise that particular question. I hope that's fine.
Sorry, can you repeat that, please?
Thank you for answering the first question. I have one other question. I'll just ask that.
Yeah.
Hi, Chetan here. Just want to know you are saying that the holding company and the operational company need to be separated because of the reason. But if we keep together, whether there would be a tax implication for the holding company and the operational activity together?
That's a good question, and that's usually when we speak to VCs or to investors, they want to keep that separately, and this is just a general business focus on keeping what's the company, that's the holding company receiving the investment separate from the operational company. And if you need to have two companies in the US, the general reason for that is to not impose a transaction, whether that's a payment or an income that you're receiving in an operational company, to be liable for the investors that are investing in your holding company. So to give you a brief or a very small example, if you have a holding company that has, I would say, like 2 or 3 investors, and those investors will receive their share of the general company or the holding company, whether that's an LLC, they will receive a K1 for their share of income or loss on that holding company. And usually holding companies, they don't generate income, they don't generate expenses, and they're just there for investment reasons. And so if you also use that holding company as an operational company and you start receiving income, those investors will also be, generally liable or taxed on the income that that LLC is generating. So if you separate both, and you have the holding company, which is not generating any income, usually, or very little expenses, and you have an operational company that's separate from that holding, then the taxation can be done, separately, and the owners, which are usually U.S. investors, USBCs, are not liable on the income that's generated on the operational company. And they're generally liable whenever they sell the stock of that holding company, instead of just year by year on the income that they're generating.
Okay. And then if it is LLC, then if it is a corporation, then what would be the same thing would be there, or it would be a change in the tax rate?
Right. So for the exit strategies, and this is a frequent question that we get asked. That depends a lot on all the variables that you have. And this depends on the shareholders, that depends on the activity, where are they located, what type of businesses, how was the exit structured? Are you selling stock from the corporation? Are you selling stock from the operational companies? So the exit strategies are usually something that goes, on a case by case level. But to go to your first question about, having a corporation instead of an LLC, that usually the vehicle itself, it doesn't really make much of a difference for the investors, because they will still, not be liable for any taxes that they will get only as a holding company. Then whether it's an LLC or a corporation, they will get, whether it's a K1 for the LLC, or in general just reporting their share of the corporation in their returns.
So currently we are not present in USA, and we are planning to create a company over there, which because there are federal tax, state tax, country tax, county tax. Is there any preferred country where you will say that this particular city has the least amount of tax, and this is the best place to locate yourself?
So what type of business are you?
So we are a B2B SaaS company, more focused on organic search. We are a business currently operating out of India. Now for expansion purpose, we are planning to locate ourselves in USA. Okay,
perfect. So usually, and again, we will have to go to the particular, case, but usually what's the standard, and we usually just recommend, the by the book solution, is to set up an LLC in Delaware, which Delaware does not have any sales tax, and it also has, what they call a corporate income tax, but that's when you are a corporation and you're also generating income in Delaware, which means that you're selling to Delaware customers or have a physical presence in Delaware, which is usually not the case. So I would recommend, the by the book, and to set up an LLC in Delaware as a first step, and then take it from there as you progress.
Okay, thanks. And you mentioned that the penalties are much lesser when a person is a US citizen as compared to non-resident in USA. Let's say if I'm traveling on a B1 visa and stay over there for, let's say, the stipulated time of 4 months or so, would I be considered as a resident because I'm traveling on a B1 visa?
So the residency status in the US, it depends on it depends on two factors. The first one is whether you have a green card, and the second one is the amount of days that you are actually physically present in the US. And this is called the substantial presence test. And it basically says if you were more than 183 days in the US for the past 3 years, then you are considered as a US resident. So in your example, if you were to travel 4 months to the United States, and that would be your only travel, in the past 3 years, then you would not be considered as a US resident because you were basically for 120 days in physically present in the United States.
Understood. That helps. Thanks.
Sure.
Thank you so much, Kaushal. I hope Federico answered your questions. I think you asked some of very interesting questions. We have one more question in the chat. It's from Rory. And it sounds like, could you share a little bit about your fees per service? Apologies if I missed this in the beginning.
Sure. No worries, Rory. You have it on record if you wanted to also catch up on what you missed. We have our fees in our website, which is what it's on the presentation. It's basically in CFOStartUp.us.io. It's where we have all the fees for the services. But I can give you a brief, in general overview of our services. Usually the onboarding or soft planning in the United States, we charge that $800 for the standard service. And to keep that in mind, we know that there are a lot of software or automation companies when it comes to incorporating in the US. We usually recommend, getting with someone to help you and guide you through the process, because again, of the penalties, and if you set up a structure or a company in the wrong way, you may be, causing more expenses in the future. So it's usually, and our recommendation and our goal and value added that we have is to guide you through what you need in every stage of your company. So that's in terms of soft landing, and also on terms of maintenance, bookkeeping, and taxes. We usually charge a fixed fee of $200 for holding companies in the United States, and this again that depends. But to give you a brief overview, which is a monthly charge for the bookkeeping, and also in that way you're paying for the preparation and the filing for your tax return for the year.
Thank you, Federico. Any other questions maybe about the tax systems? Thank you, Rory. I can
leave my email here, and if you like, anyone, we can set up a call and continue the discussion, for your particular case.
Thank you, Federico. Yeah, by the way, Federico's email is in the chat already. I hope everybody can see it. So we still have like around 10 minutes left. And if there are any other questions, you can actually join us on stage and ask yourself, or also drop it in the chat, as you prefer. Okay, Kaushal is raising a hand one more time. 1 second. I will. Okay. Kaushal, you're on stage.
Thank you, Sareen. So the other question, Federico, that I have is, how much is usually the economic nexus tax and the physical nexus tax? Because yes, the team members would be spread across USA. So do we have to pay taxes in each and every country? And how easy it is to pay this many taxes at different places? Because our business is mostly online. So there are no offices. People would be working from home, and they will be working from home across the state.
Okay. Yeah, that's a good question. So the first thing to consider is you need to see on the physical nexus would apply to this case, and the location of the employees will be what your general rule to incorporate in that state, and also incorporate your employee in that state and start paying taxes for them. So usually how it goes is you have two things when it comes to employees in the US, the payroll taxes and the sales taxes. So you would have to first set up your company and incorporate that company in that state. And this means if you are set up in Delaware, you also need to register that company in, I would say, Florida or California. And then the second step would be to register your employee in that state, because usually states they collect taxes for the payroll taxes for your employees and so on. And the third step would be to start their payroll and paying their taxes in each of the states. So the three-step process and the third process is usually, in the United States, you will see that it has a lot of tools and a lot of different applications that help you through all the process. And the third step about paying the payroll and paying the taxes is usually what we use. We use a tool which is called Gusto or Gasto that centralizes all the tax payments and the tax filings, so that you don't need to worry about whether or not you're paying for the right amount of taxes for that employee. So that's on the payroll side. And on the sales side, what you need to do is determine if you have the economic nexus, and each of the states has its own legislation, whether you're selling services or depends on the activity. But in general, what you would need to do is determine how much of the sales that you're generating are from the state in which your employee is set up in. So, brief example, if you have 100 of sales in the US, and you would say that employee in Florida is contributing to 10% of that income, then 10 out of that 100 would be considered as nexus to Florida. And in that case, you may be liable to sales tax and you may be liable to income tax in that state. But again, that depends on a state by state. I would suggest, seeing what your structure will look like, where are the employees going to be located, and then planning according to that.
Okay, fine. But the tax would be somewhat around 10% or so for the Nexus tax.
You can take that as an estimate, but again, it will depend on a state by state.
Perfect. That helps. Thank you.
Thank you, Federico. Thank you, Kaushal, for your question. I think you can also save Federico's email address from the chat, and if there will be more questions, ask him. Now we have one more question from Vivi, I guess, from the user, but it's an interesting question. So it sounds, I've heard some LATAM companies try to implement something called Cayman sandwich structure of companies. What is that? This sandwich consists of local operating company, a company in Cayman, and last in an LLC in Delaware. So,
right, that's also a very frequent or a very common structure that's in some cases required by a ABC or an investor. And it consists in what exactly you were saying. Usually there's a company in Cayman, which is the holding company, and then you would have an LLC in Delaware, and then a local operating company which is owned by that LLC in Delaware. So that's where you have the sandwich. The sandwich is between Cayman and the operating company locally, and the LLC in US is usually the ones that the investors have, and the one that gets that they would invest in the LLC basically. And this, and to give you a brief overview, or generally what the reason for this is that when you have an LLC in Delaware, everything passes through the owners of that LLC, right? And in terms of the ownership of the LLC, that's when the Cayman company comes in, and when the members of the LLC come in, and that's where usually there's a risk protection for the owners, and also to make the structure much more tax efficient than it could be in terms of an exit or in terms of the general operations. But again, and you will see a lot of articles going around and a lot of different interpretations of the legislation in the US or internationally. But it's the most important thing, I think, is to see your business, see your activity, to look at where your owners are, where your shareholders are, the residency, and then determine the right step. And the right step is usually going from small to big. You don't need to create a sandwich company if you're thinking about operating in the US. You can start by creating an LLC and then seeing as the structure, and as your business progresses, to see how you can structure it to make it more tax efficient or more legally protected for the shareholders. But we usually recommend a by-the-book solution to set up the LLC and then move from there on, because the Cayman structures are usually much more expensive to create and also to maintain year by year. So you don't need to incur in costs if your business and if your activity does not require it to. So that's what I would suggest, to go on a simple basis to creating what's going to usually be needed, which is the LLC in Delaware, and then move from there.
Thank you so much, Federico. I hope it did answer. Yeah, okay, thank you. So that indeed already said it's fine. So I think it's about time to wrap this session up. Again, if there is one more question, if anybody has, we still have time for one question, you can drop it in the chat. But for now, let me just quickly, one second, there is one more question. Can we have the company registered in the USA, but yet transfer all the receipts to India?
So, Kaushal, are you thinking about, registering a company in the US, but having all of the expenses and income in your Indian subsidiary? Is that what the question is about?
Yes.
Okay. So I would say that the general rule that you have to follow is, where are you, and in terms of receipts, can be something that you're receiving or something that you're paying. In terms of something that you're receiving, it could be, where are you providing the service from? Are you providing it from India, from the US? Where is your workforce located? Is it in India? Is it in the US? And in terms of that, you could do some strategic planning on where it's more efficient to, allocate the income or allocate the expenses. So you were saying 99% India, 1% USA. In that case, usually what the rule would be is to register it in India, but I would take a look and see the actual structure and the actual business, the actual clients that you have, and where it's beneficial for you to register the receipts that you're getting from your clients or customers. Because usually we have a structure where you have a holding company, and then you have companies, also subsidiaries around the world, and if you're making the billing from the US LLC, the US corporation, and you have all the costs somewhere in a subsidiary, you may be asking yourself whether that structure is efficient or not, because you have all of the income in the US, but all of the expense in a subsidiary. So that's what I would suggest looking at when you are thinking about transferring the receipts, is where do you have the income, where do you have the expenses, and where does it make sense, on a reasonable basis to have everything.
Thank you, Federico, again. So I think it is about time to finalize this session. First of all, Federico, of course, I would like to thank you for all the information you shared. I mean, from the Q&A session, I see that this was a quite interesting topic for the participants and for the attendees. Like, we were in a small group today, but still, it's really nice to see that the audience was like engaged and interested in the topic. So thanks a lot for taking this time and sharing a lot about specific topics with all of us. I would like to thank all the participants as well for dedicating this 1 hour and attending the session. Just once again, I would like to say that we will be sharing with you the presentation and the recording, and maybe before everybody leaves, I just would like to launch a small poll. So this is just to get to know you all a little bit more. I guess you can see it already on your screen. We just want to know what is your role. Okay, so I see we have startup founders here, we have mentor, we have startup team member today in the group. Okay, so 4 people voted, but okay, that's so interesting. So 1 second, I'll just close this. So yeah, thank you so much, everyone. Federico, I will also reach out to you with more information about the results of the event. And have a great day, everyone. I know for Federico it is morning, for me it is evening. So have a great day, evening, morning, and feel free to reach out to Federico if you have more questions on this topic. And yeah, and thank you, everyone, once again.
Yeah, thank you so much, everyone, for attending. I hope you have a good time, and feel free to reach out if you need anything. And thank you very much, Serena and Seedstars, for the opportunity.
Thank you. Bye-bye. Take care.
Bye.